How does investment boost work? There's been plenty of talk about this investment boost recently, and a lot of people have actually got it wrong and misinterpreted. So we're going to give you some examples to help you better understand it. Mate, I've heard everything from people are going to be voting for National because the business owners are getting another handout.
Wow.
To
It's deep.
you get given money, and also it makes your ute cheaper and all sorts of different things. So we're going to try and help people really understand it.
We'll unpack a little bit. I imagine most people that are familiar with Investment Boost will be boosting down to their local Ford dealership, and I do understand that inquiries for Ford Rangers are at an all-time high, and with field days coming up, the expectation or anticipation is going to be a massive inquiry, not only on Ford Rangers, but just plant and machinery in general.
Yeah.
But you're quite right that when there's changes to the tax rules and there's like a rebate or there's some type of incentive, most people interpret that to being, oh, I'm getting cash back. And the example for easy maths, because I'm a simple person, if we buy something for $100,000 and it qualifies for investment boost, 20% of 100,000 is 20,000. People are thinking, oh, I'm going to get 20 grand back from the government. Wrong answer. No, you don't. It is a $20,000 expense to your P&L. So you're going to have sales minus cost of sales equals gross profit, less your overheads. And in overheads, what we're probably going to see is a line called investment boost deduction or something like that. Or it might in fact be on your tax note, depending on how nerdy your accountant wants to be. And that $20,000 will then come off of your profit, which will reduce your tax. So you're essentially, the tax benefit is your effective tax rate multiplied by the $20,000.
Yeah. And I think that's where people are misunderstanding it anyway. It's basically not getting to that level of detail. It's basically, as you say, oh, I'm getting something back, because the terminology that people are using is rebate or tax credit and things. So people are thinking, well, okay, well, I'm going to get a credit. But I thought maybe we could step through the depreciation rules prior to investment boost so that people can get a feeling for that, and then what it looks like with investment boost. So
Smart.
if we take your $100,000 piece of equipment, and we say that would normally depreciate over the useful life of that asset. So let's say that depreciates at 20%. So each full year of depreciation would be $20,000, right?
Yep.
So that's going to be your $20,000 expense that goes to your profit and loss, and that decreases your profit and therefore the tax that you pay. Now remember, depreciation is an on-paper tax expense. So if your tax rate is 33% because you're earning over $78,000, let's say, then your tax saving on this depreciation is $6,600. So you're not having to pay tax of $6,600 because you have depreciation. So those are the ordinary rules.
Yep, before investment boost.
Yeah. And now investment boost comes along, and now we get an immediate tax deductible expense. So our $100,000 means that we can claim $20,000 in a tax expense straight away.
Yep.
And then we depreciate the remaining $80,000 over the useful life of the asset. So if we keep the rates the same, well, it's going to be 20%. So the depreciation for a full year of depreciation, I'm emphasizing full year.
There's going to be some nerds out there on the comments, eh?
Yeah.
I'm waiting for the nerds to come on and go, oh, but Luke, you haven't considered a diminishing value. You're assuming straight line. Okay, Punishers, this is just a...
And that's why those people are on their keyboards, being keyboard engineers that have never actually built anything, and we're in the arena getting shit done. So the full depreciation on that would be $16,000. So now we've got...
So that $16,000 is your $80,000 multiplied by 20%, because 8 twos are 16, so $16,000 expense
It's
deduction.
very sharp, ladies and gentlemen.
Oh, I've been polishing up on my basic facts, mate. The 1 + 1 is 2.
Good man. So you've got your $20,000 expense from investment boost plus your $16,000 of depreciation. You have a combined tax deductible expense of $36,000. Now before we said lower profits mean less tax. So very clearly you're claiming more depreciation. So if your tax rate is 33%, your tax savings on investment boost plus the depreciation would be 33% of the $36,000, which would be $11,880. So that's basically bringing forward a non-payment of tax of $5,280. So your expenses are larger, your profit is less, therefore your tax is less. So what it is saying is that it's accelerating the use of that vehicle, of the equipment or the asset that you're buying, and it has to be new, of course, as well. and therefore not having to pay $5,280 of tax that you would have ordinarily needed to pay. Now, there's a couple of caveats that I think a lot of people are forgetting about. One is that when you sell an asset, you may have overclaimed depreciation in that period and therefore have tax to pay on depreciation recovered. We can maybe come back to that. But also, most people finance assets, so they still need to make loan repayments with after-tax business profits. So part of, if we go back to the prior to investment boost, we can claim depreciation, but the depreciation sort of brings our profit down so that we can smooth the cost of that asset over its useful life. Because through that as well, remember we're paying off the loan. And I think a lot of people forget about that. So I think we're getting a little bit of a tax incentive anyway so that we can still meet our loan repayment. So instead of paying more tax, we're able to clear the debt. But that's why you can't expense the entire asset, the whole $100,000 piece of equipment in one go.
Wouldn't that be great?
Would be very good. And then investment boost allows an immediate 20% deduction no matter the time of the financial year the asset is purchased. Now, this is the bit that I think is probably going to get people excited.
So there's no apportionment. You get 20% of the, say, $100,000 in one lump sum. We don't have to go 6/12 or 8/12 to go, oh, you've purchased it in whatever month, so da-da-da. It's just a lump sum. So you could buy it in March next year, and you're getting a deduction of 20 grand, even though only for 1 month of the financial year.
And I think Phil's nailed it. That's what we're going to see because we understand buyer behaviour, we understand consumer behaviour. We work with hundreds of business owners every year, probably speak to thousands. We know what they're like. And I guarantee you at February and March next year, there's going to be marketing to business owners saying, hey, if you buy before the end of the financial year, you will get the tax deduction on the investment boost. So if we're to think about that, if we go and buy that $100,000 worth of equipment in March, well, we can claim the 20% on it under the investment boost rules, but we can only claim the days that we've owned it through to the end of the financial year for the normal depreciation. So that's why I was emphasizing full year because this example was only really good if you were buying it on the 1st of April.
Spot on.
To then claim the depreciation for the entire time. But people are going to get excited by the fact of, well, if I go and spend this money before the end of the financial year, then I'm going to be able to claim 20% of it as an expense to then bring my tax down. Now, all good and well if you actually need that equipment and it's going to help make your business more productive, etc. But I think for a lot of people, it will just end up in cars.
Oh, 100%. And I think the other bits of detail in investment boost to really hammer home is it only applies to brand new assets. So we can't go and buy a second-hand Ranger. We can't go on Trade Me and buy a second-hand tractor. We can't go and buy a second-hand
Tesla.
CNC machine or a Tesla. There'll be plenty of those around. People will be paying you to take. You'll be paying them to take it off your hands.
Going that way.
So we've got to emphasise that it's new assets. What does qualify are second-hand assets that are imported into New Zealand that have never been used in New Zealand before. So whether that qualifies for second-hand imported cars, I don't know. I'm not a car person on second-hand Japanese cars because that's probably what it would apply to. But it's really, I think, the intention of this policy or the legislation is to incentivize people to invest in productivity-generating assets. So a lot of people, I think, in business, particularly the SME business owners, could get caught in the trap that Luke was alluding to earlier. We just go, oh, sweet, I've got this incentive to go out and spend some money on a new vehicle. I don't actually need the new vehicle. I want it, so I'll just go and do it. I'll load it up on finance, happy days. Then your business, actually, the profitability needle hasn't moved. So you're having to spread the profit that you have got much thinner across a much higher debt load because you've just invested in an asset that isn't actually contributing to your top line, despite you probably rationalizing it somehow to go, oh, you're driving around in a new Ranger that I'm going to get plastered with the latest branding is going to generate more sales. Probably not. But if you actually went and go, well, no, I've got this piece of equipment that's really old, I'll get rid of that and I'll go and make a commitment to invest in something brand new that's going to have some efficiency gains in my business, and then I'm going to go out there and be hungry for some more work. Absolutely, that's the intention of it. But there's a real risk that the the smaller end of the plant and machinery, plant and equipment, vehicles, it's just going to go gangbusters in the short term.
I saw a really good example this week where I thought it really applies to a business like this. Now, it was a business that I guess is on the way up and growing, but it's down south and they do big drones to do spraying. And then they go and provide those services to farmers. So traditionally they might need to get a chopper to come in. So I don't think the chopper industry are going to be too stoked with this.
No.
But instead, they're chucking up these drones and going and doing some spraying for the farmer, and then happy days, invoice them, get paid, and on to the next one. But those pieces of equipment could be $60,000. Now, if you're new to that, because it's a new type of business, you're going to be hamstrung by needing the capital to then be able to buy those assets. But if you've got like a pipeline of work, but you don't have the equipment, and you know that you're going to get a 20% tax deduction on it, it probably makes you go, right, well, I'm going to be able to get finance for this because someone's going to asset finance it, and you probably pay 9% on it. And then you go, right, well, I'm going to speed up my journey. You might not take as long to buy the next drone. You might say, right, well, I know that I'm getting effectively bringing forward my depreciation, and therefore I'm going to go and buy another one faster than what you may have ordinarily gone and purchased, instead of waiting for your profits to build up to then have enough to go and get the next one. It may speed up your purchase of it, and therefore needing a drone operator for it, and therefore hiring. And I think that was the design of the tax incentive or the investment boost, was to see productive assets and then jobs created through people using the machinery or the assets purchased.
It would be interesting to reconcile, this is getting nerdy, the inquiry at the plant and machinery level for brand new stuff, particularly vehicles, as I keep saying, and then go and reconcile that to finance applications and go, what's the conversion? Because as much as people go, oh, yep, got this in, I'm going to go off and do this, and this, the overwhelming majority of all of the stuff has got to be debt funded. Yeah. And you're going to be at the mercy of whoever that debt provider is, probably a bank, and they are either going to tick it or stamp it and go, nah, this hasn't passed the credit team, see you later. And I think there's probably been some businesses out there that have neglected their P&L and neglected their balance sheet, and have really taken the good times for granted that we've spoken so often about, and they're really stretched to the limit that they're not any more bankable. You know, as much as you want to go out and invest in your business in productivity generating assets or another car, dare we say it, the bank could ultimately come along and go, well, we know that's what you want to do, but no, because we've got real questions over your ability to service the debt. The example would be, and this is where I think a lot of tradies are going to come unstuck, the construction sector, as we know, is absolutely squeezed at the moment. There is bugger all going on. People are screaming out for work, like we've said, I don't know how many times now. And you're going to have all these tradies going, oh man, this blooming ute that's in the driveway, it's 2.5, 3 years old. I need the new one. I need the new one. And to go and present your financials, and it'd be funny to see how many accountants are out there, those of you who are listening, might be able to drop in the comments and say, yeah, I'm actually getting a lot of inquiries for, hey, can I get my drafts done so I can apply for vehicle finance? For the bank to ultimately go, no, because you're not generating enough to be able to service any more debt. So you haven't done the work in the first place to be able to go, you actually deserve a productivity generating asset. So that's going to be an interesting one to watch unfold.
Yeah, I would say that those finance companies like the UDCs, etc., that do quite a bit of asset finance will be all over these rules, and yeah, they'll have good data on it. I'd say they're going to be very busy. They
will be very busy, and how many of them convert be interesting. But I mean, if somebody's prepared to decline it, there'll be somebody out there that is going to be prepared to say yes. So you might have a UDC, for example, that's at 9, 12% potentially.
Yeah.
There'll be, let's call it dirty debt that's out there. That's going to be 15, 18, 20+%. And they'll give you a yes, not naming names, but they're out there. And if you're having to go and get dirty debt just to satisfy your ego on a piece of asset that you don't necessarily need, the answer's in the interest charge that you're paying. Like, it's a dumb decision. Don't do it.
The funny thing with tradies, let's say, that are buying these vehicles, you know, they'd probably never hire an $80,000 salesperson, but they'll pay that for a Ranger.
Yeah.
And think that that's what's going to generate them new income, and use that to validate the decision
100%.
to buy it. But if you said, okay, let's hire a salesperson for a year, then you're going to have so much work that you'll be able to buy the Ranger without debt. No way. No.
Yeah.
No.
Well,
Yes.
one's ego-fueled versus taking a punt on your future self. And I mean, that's a topic to unpack for another day, but the amount of people, and I guess to sidetrack a little bit, tangent, we haven't done a tangent for a while. We don't have the little buzzers with this gear. But boomer businesses and the ones that we do due diligence reviews on are absolute freaking ripe for it. That they just milk the profits out of the company, wonder why they battle so much, because they haven't reinvested back into the business to make it scalable, saleable, all of that kind of good stuff that we talk about. And what you've just alluded to is somewhat similar. It's just like we want the good stuff, but we don't want to take a little bit of short-term sacrifice to have something better later on.
Yeah, the old instant gratification. I think as well the comments would be full with people, and people would be screaming from their Raptors right now saying, yeah, but I needed a ute. That's the difference, mate. I still needed a ute.
Yeah.
And so I needed it. You don't understand. Okay, we do understand. Chill out. Hey, you can also claim for new commercial and industrial buildings, improvements to depreciable property, but not residential boxes of sticks. Buildings. Primary sector land improvements, assets arising from petroleum development expenditure and mineral mining development expenditure incurred on or after 22nd of May, and even mixed use assets. So,
Drill, baby, drill, in the famous words of Shane Jones. And what I really liked about this was the legislation was introduced into the House Parliament on budget day, and it was obviously passed, and it's effective from the 22nd of May. So that really shows the government's intention that their chat around growth, they're backing it up by bringing in some legislation policy that's going to go, right, this is going to have an impact. We're not going to delay it. Let's not wait until the 1st of October or the 1st of April or some other arbitrary date. We're going now.
yeah, right into it. What you cannot claim for, second-hand assets that are sourced from New Zealand, residential rental buildings.
I love that one.
I love how they have to spell it out. Most fixed life intangible assets such as patents. Now, there's a page that the IRD have put together. It's 6 days old at the time of recording. If you Google IRD New Assets Investment Boost, and it is very simple to understand. It's very clear this. It's not tricky, so therefore you shouldn't be getting, I'm going to say this, you shouldn't be getting large bills from your accountant to give you advice around investment boost, because I can guarantee that some of them will be like, okay, you know, you've asked for our advice, bang, here's a accounting fee, and it's probably going to erode some of the tax bloody benefit that you'd be getting from this.
Mate, it would be 10 phone calls, an easy $500 per phone call. There's $5,000
Yeah.
for an accountant.
Yep.
And we know some of them do it plus the disbursements for all the paper that they've used for the phone call about investment boost, because they would have had to have printed this thing that Nigel created probably 27 times.
To circulate around the office, and you're paying for it. Yeah, the big disbursements. So Google that page if you do want to have a read of it. We need to touch on depreciation recovered very quickly. It's on this page, but we have talked about it before in prior pods. But remember, when you go and you sell an asset, it sells for a book value, or the technical term, I believe, is adjusted tax value. I call it a book value, but if we think about what's the value of the equipment in the books, because that's the cost price less the depreciation gives us our book value or our adjusted tax value, and that's what in accounting terms we think it's worth. So that equipment before, if we say that it is depreciating, then we're going to have a book value for that, and then our market value will be what someone's prepared to pay for it after GST. Now the difference is either going to be a loss on sale, which is an expense to you because you've sold it for even less than what the book value is, and the market's saying, no, that depreciated faster than that. Probably a Tesla is a good example of that. Will probably sell less than the book value, but when you're going to have a gain on sale, depreciation recovered, will be when you sell it for more than the book value. So basically the rules are saying, well, you've claimed too much depreciation on this. So a good example of that would probably be a Raptor or something like that are really fashionable, and every now and then people go to sell them, and they haven't depreciated as fast as the accounting rules have allowed. And then we say, well, you've claimed too much depreciation, therefore that's income, therefore you must pay tax on that income.
Where we see that typically happening is not in the Ford market, but more so in the Toyota Hilux line, because those things, I do believe, when you're comparing ute to ute, probably tick a few more quality boxes.
Yeah.
So I'm led to believe. So if you want to assess depreciation recovery or depreciation loss on sale, you're probably going to be better off on a Hilux. And in some cases, particularly in the post-COVID environment where vehicles were quite frothy and there was a lot of demand and the car dealers out there were looking for a lot of second-hand stock and people were trading in, they were actually selling them for more. And I saw cases of some clients where they had a vehicle on the books for $16,000 and then they ended up selling it for way over $20,000, $30,000. And I'm just like, holy moly.
Yeah. So in that case, they've claimed too much depreciation. The IRD will say, well, sorry, you still stick to market value. So as exciting as this investment boost is, eventually these assets will be sold and you'll either have a gain on that sale, which will then effectively like null and void all the claim that you did. So it's just a timing difference and speeding up the timing of tax payment.
My biggest, I'm a massive fan of investment boost. Like when I zoom out and look at it at a much bigger scale of some of the investment, infrastructure and larger scale projects that are potentially coming online in New Zealand, this is a good thing to the wheel spinning and construction industry moving and keep people in jobs. I could go on about it for a while. But when we talk about it in the context of SMEs, my biggest worry about it, with it being such a good thing, is business owners not understanding the cash flow impacts, and that they'll go and get an asset, take on the debt, but then not understand cash flow. Because the thing that we need to think about is go, right, in year one, we're saving tax, and then in year two, your accountant's going to send you a prov tax notice, and it's going to be less than your prov tax obligation is going to be based on the year that you've claimed investment boost. So you're going to be paying an arbitrary lower amount of provisional tax because you've had this one-off expense in your P&L. Because the accountant's just sending you the standard uplift notice, like what we've spoken about before. And then you're going to come along a full year, have your accounts done. You would have paid provisional tax based on what your accountant said with those notices going out. And it's just like, oh, hang on a minute. There's a tax surprise because investment boost skewed how much provisional tax I needed to pay. So in year two, you're going to have a tax catch-up. There's going to be so many business owners out there that potentially could get caught out with a tax surprise.
And people hate tax surprises.
They sure do.
The other thing to think about too, to give people an example, is if we take a $4,000 laptop, say, that thing's going to zero eventually.
Yeah.
Because you're going to ride it until it's buggered. And so you're going to expense the whole $4,000. You're just not allowed to do it in one go. So you're going to expense it over the useful life, but one day you're going to go onto it, it's going to have a virus and there's going to be a Russian hacker in it and you're going to go, I'm going to have to write this thing off. And basically it's still worth $1,200 in the books and you'll go, scrap it, we're not even opening that again, we're too scared. And basically that thing now has a market value of zero because you're not going to resell it or do anything with it, and basically it just gets binned or recycled. So you're still claiming your whole $4,000, but you're just doing it over the useful life. Now, with the investment boost, it's the same thing. You're still claiming the $4,000. You're just, again, speeding up, being able to claim 20% straight away.
The other thing that makes me nervous about this is if you're a believer of a one-term government, that this coalition of three, I don't know what the cushy name that the media call them, decide.
Enact.
Is that what it is?
I think so.
Yeah, I haven't heard it. It's obviously on Boomer FM. They don't like to bag them, you see.
Oh. So
I've got to tune into Radio New Zealand just to pick up what the slang words are. Maybe I need to do that next week, tune in. Is that if there's a risk that there's a one-term government, any new government that's presumably headed by Labour, unless the Greens start and overtake them in the polls and become the opposition party, which could be a reality. I mean, with their budget, it was so compelling, they could actually get to the top of the polls. But anyway, that's a story for another day. The risk is that investment boost is unwound and repealed. So where this rule comes in from the 22nd of May and there's no limits on it, you could buy an asset for $5,000 or you could buy an asset for $5 million. The rules are exactly the same. But the risk of the window could only be 18 months or 2 years before it's all undone.
Yeah, that would shed a lot of people. I almost feel like they've done so much with this that like they really do. They seem with tax, they hate flip-flopping between tax rules, but commercial building tax seems to be something they do flip-flop with. Residential interest deductions for rentals was sort of something, but other than that, there's not too much like flip-flopping. So I'd be surprised if Labour go, you know what, like I don't think that's going to win them an election, being like but it would definitely be something they could tinker with to then balance a budget.
100%. I haven't seen anything to suggest that they would get rid of it, and they've come out, oh no, this is not for us. We wouldn't do this.
Yeah.
But if you're got a project that's $5 million, $10 million, $50 million, I don't know. There's some big stuff that goes on out there, and it's overseas money come in. You're going to want some certainty about the rules.
Yeah.
And I imagine there'll probably be a few phone calls to Chippy and Chloe, just going, yo, fellas, let's sit around the table, and this is what we got going on. Are you likely to pull the rug out from underneath us? Because this is potentially a 3-year project that we're going to invest in, and we need to have some certainty that these rules are going to be in place at the end so we get our 20% sugar.
You're not suggesting that people with money have some sort of say in how elections end up playing out, are you?
No, I wouldn't suggest that at all. I mean, it's all democratically elected, and there would be no influence, I don't believe, with rugby tickets or first-class airfares or access to lounges or, Gucci bags or anything like that.
Yeah, I don't believe that any property developers donated money to National over the last 4 years, but yeah, I could be wrong. I just have to look into that.
Yeah.
Anyway, hey, there's a really good example on the ID site where it talks about Queen City Carriers as a transport and logistics business that wants to expand its fleet of trucks in Auckland. They're Warkworth based as well.
Yeah, nice.
And I don't think they'll succeed up there because there's already a very successful business up there that excels in this space. But anyway, Queen City Carriers, they invest in 4 new trucks for $75,000 each. So that comes to $300,000 worth of new kit, and expand their fenced parking lot to accommodate them at a cost of $200,000 for new fencing. So in total, the new trucks plus the land improvements cost $500,000. Queen City Carriers have really dug deep, and they can now claim 20% of the total cost as a deduction in that year's tax return. That's $100,000.
That's a nice simple one, and it covers a number of different things. 1, brand new vehicles, and 2, investments to improvements to commercial property. So you're probably thinking about, a fence, how does that qualify? Well, it's not a residential property, it's commercial, it's an improvement, it's over the threshold, so it's an asset. So 500,000, 5 2s of 10, so there's $100,000 tax benefit. No doubt they would have got that fully funded from somebody like Kiwi Bank.
Yeah, it may well be. I do believe that there is a little bit of an undercurrent of earthquake work need started.
Yes.
And this really incentivizes them to get off the sidelines and get going with spending the money to do that.
Hey, and that's probably where I might be getting a tad too premature shock on any risk of the policy being unwound government. A lot of that work is down in Wellington. And we know the Wellington economy needs an injection of some sort to get the wheels turning and these cafes and people in happier moods. You were just down there. I don't know what the mood of the city's like, but I understand it's pretty shite. Maybe Investment Boost is going to be their saviour because there's all the earthquake strengthening work to get underway.
Well, I did see something interesting on my travels to Wellington today, and that was a police person is the correct terminology to use in Wellington.
Yep.
Standing behind a sign.
Yes.
And all you could see was their legs. I wouldn't have spotted it because I would have been distracted on my phone. Just kidding. But that's exactly what they were doing. They were basically spotting in the crawling traffic the people on their phone, and they would say, well, you, and there was cops then ahead of them, police people ahead of them, and they would pull you in, and there was probably 3 or 4 cars just constantly like go in, get your fine, do a U-turn,
so it's a drive-through.
carry on. Yeah. And they were
not the kind of drive-through you want to go.
No, not the KFC, but they were just printing cash.
Wow.
So, yeah, people were heading on their normal commute, but it was quite smart. It was almost, I thought there's some like military technique that's sort of obscure by the sign, and you wouldn't even see them until you get there, and then you realise, oh, wow, they're right there, and they see you on your phone and going 3 Ks an hour.
Yeah.
Really productive, really productive economy down there going 3 Ks an hour. Yeah, they looked like they were still making plenty of money, the police down there, keeping the roads safe.
Good on them.
Yeah.
Look, I'm comforted to know that if I'm ever travelling in the Wellington region that they're going to be safe drivers because the rules are being reinforced, unlike Auckland, who are just a bunch of lunatics.
Now, coming towards us were also a number of cars, and I did wonder where the Danny Verk courtesy, maybe it was just a Danny Verk thing, but we used to have this thing where you could sort of flash your lights. It's just to warn people of things, hazards that are coming up.
Hazards, yeah, that's a good way to put it. Yeah, just cool your jets. None of that in Wellington.
No, I did get a bit of tooting in the tunnel. People getting horny in the tunnel, which I liked.
Right.
Yeah, really getting horny.
Were you in an Uber?
No, I got picked up.
You got
but
picked
I Ubered
up
back. Yeah.
Right.
Yeah, and I did ask the Uber driver what his cologne was on the way back as well.
Yeah, and what was it?
It was an Indian traditional rose-based cologne, apparently.
Interesting. It produced Dior?
No, not quite by
No.
one of the premium brands, mate. I think this was more traditional.
Yeah, okay.
Yeah.
Yeah, nice.
That's about all I got to say from Wellington, mate.
Good. Have we got anything else on Investment Boost? Because we've, as usual, gone down a bit of a tangent.
Yeah, I just think hopefully that dispels a few rumours or misunderstandings of it. And again, like reach out to your accountant, but maybe tell them how you think it works before you ring, and then they have the same conversation, and then you get a bill for $500 and you kind of null and void a bit of your tax claim anyway. Maybe even give ChatGPT your understanding of it and see if it's accurate, and then you might save yourself an accounting fee. But yeah, stick to the IRD website to get a couple more of those examples. So Google Investment Boost New Assets IRD.
Yeah, and I think you raise a good point, which highlights something that we always beat the drum on, is any major decisions that you're looking at doing in your business, involve your accountant, because they'll help you structure it right, give you the right advice, and there'll be stuff like this that you potentially make a decision and you didn't even know that Investment Boost was a thing, or it might help you make a better decision. So pick up the phone, send an email, whatever way you do, involve your accountant.